Hello financial fans, welcome back to another stock analysis. Today we'll be covering Papa John's stock ticker PZZA. Papa John's is a multinational pizza delivery and carryout company. They operate a network of company-owned and franchise-owned stores. They offer a variety of pizzas, sides, and desserts, as well as a range of toppings and sauces that customers can choose from. Customers can place their order online through mobile app or by phone for delivery or carryout. They also offer the option of ordering through voice assistants such as Amazon Alexa and Google Assistant. Papa John's also offers a loyalty program called Papa Rewards, where customers can earn points with each purchase and redeem them for free menu items. In addition, Papa John's also has a fundraising program that allows schools, sports teams, and other organizations to raise money by selling Papa John's pizza. Overall, Papa John's is a pizza delivery and carryout company that allows customers to order food and offers a loyalty program, and it has a fundraising program for organizations. They currently have around 5,589 locations, and their market cap is sitting at $2.8 billion. Their revenue in 2021 was $2.07 billion, and the dividend yield is sitting at 2.09%. 49% of their revenue comes from North American commissary stores, 38% from domestic company-owned stores, 7% from international, and 6% from franchise royalties. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on financial ratios, the financial health, and the growth of the company. We'll be using a standard margin of safety of 25%, which can either increase or decrease by the ratios that we'll look at in just a moment. The severity that the margin of safety will increase or decrease by will be determined by using the scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from a margin of safety. The first 2 ratios that we'll look at are the EBIT growth and the margin growth. The EBIT has grown from $103 million in 2012 to $181 million in 2021, taking a huge hit in 2018, 2019, and 2020, but managing to recover itself. Even though they managed to recover themselves, the EBIT growth is still only 1.8%, meaning a 5% increase in a margin of safety. The margin has grown from 7.67% in 2012 to 8.75% in 2021, also taking in a big hit in the same years as the EBIT. Similar to the EBIT, it has also managed to regain itself, but the margin growth is still minus 4.3%, meaning another 5% increase in a margin of safety. The next 2 ratios are the dividend growth and the payout ratio. The dividends have gone from 56 cents a share in 2014 to $1.68 a share in 2022. The dividend growth during this period was 15.9%, meaning a 10% deduction from a margin of safety. The payout ratio is sitting at a relatively high 77.7%, meaning barely no change in a margin of safety. The final 2 ratios that we'll be looking at are the debt to EBITDA and the return on invested capital. To get our debt to EBITDA ratio, we have to take the debt, subtract the cash from it, and then divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. In this case for Papa John, it's just under 3 years, which is in this case a 273% debt to EBITDA ratio, meaning no change in the margin of safety. The return on invested capital, however, is sitting at a very solid 19.7%, meaning a 5% deduction from our margin of safety. Let's go look at the valuation models next to determine the intrinsic value of Papa John's. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow going from 2012 to 2021. The average growth in cash flow during this period was 53.11%, but we're calculating the expected growth up until 2030 in free cash flow for Papa John's, so I've gone with only 15% of this average growth, which is just under 8%. With this percentage, we can determine the future free cash flow of Papa John's and determine a terminal year valuation, using a perpetual growth rate of 3% and a discount rate of 8.5%. Out of this, we get a sum of free cash flow of just under $3 billion, and all that we have to do to get our equity value is add the cash and equivalents and subtract the debt. Then we get an equity value of $2.3 billion. And to get our discounted cash flow price per share, we have to divide it by the amount of shares outstanding. Then, doing this, we get a discounted cash flow price per share of $65.73, and with the current price of $80.39, we get a downside of $14.66 out of this model, which is an 18.24% downside. Second model that we'll be using is the dividend discount model. I've imported the dividend payouts going from 4 years ago to the current year. The average growth in dividends during this period was 18.89%. But since we're calculating the lifetime expected growth in dividends for Papa John's, I'm going with 35% of this average growth rate, which is 6.61%. In this valuation, we'll also once again be using a discount rate of 8.5%. Out of this model then, we get a discounted dividend model price per share of $94.82, and with the current price of $80.39, we get an upside of $14.43, which is almost an 18% upside. The final model that we'll be using is the multiple valuation. By looking at similar companies to Papa John's, look at their stock price and the earnings per share, we can determine the average PE multiple in the industry, which in this case is 33.52. All that's left to do then to get our fair value here is multiply by the earnings per share that Papa John's is generating, which in this case is $1.93 per share. Then out of this model we get a fair value of $64.69, and with once again the current price of $80.39, here we get a downside of $15.70, which is a 19.5% downside. Let's go look at the final overview of our valuation models next. Looking at our final overview, we've imported the discounted cash flow, discounted dividend, and multiple valuation prices per share. Out of this, we get an average of $75.08. The margin of safety we've determined earlier, which using a standard margin of safety of 25%, adding 5% for the EBIT growth, adding 5% for the margin growth, deducting 5% for the return on invested capital, and deducting 10% for the dividend growth, leaving us with a margin of safety of 20%. Then our fair value will become $60.06, and with the current price of $80.39, we come to a downside of 25.28%. So in this case, looking at our models, it will be a sell. If there's any other companies that you would like to see on this channel, please let me know in the comments. And thanks for watching.